traders. This week, very volatile week, as I have already promised in my last video how February will be, and you have seen that we have a very volatile week, a week of a lot of tensions, and of course, last not least, President Trump, Ukraine war, peace process, and everything. And the focus on the market is now that the market is kind of more optimistic. First of all, President Trump pushing Ukraine more under pressure to, and also Europeans to make peace. On the other side, a lot of peaceful news between the trade war, China and the United States, that if Chinese would invest in the United States, then Trump maybe will release their tariffs. That's of course good news for the market. President Trump is boosting pressure on Ukraine to strike a peace agreement with Russia, stoking concerns about European allies, of course, that he would reverse years of support of the Eastern European country. He further added also the uncertainties surrounding his tariff plans by discussing a potential 25% lumber fee. That's very important, for example, for Canada. It means that the U.S. equities and U.S. equities index futures fell. Therefore, the yen reached its highest level versus the US dollar since December, on mounting speculation that the Bank of Japan may raise interest rates sooner than later. So what we have experienced during the last years in Europe and United States, now the Japanese are experiencing them. So that would be, of course, on the other side, pushing up the bonds, the US bonds, and increasing of the US bonds and yields, of course, would hike possibilities of pushing the US dollar higher. That would again create more pressure on the stock market and of course on crypto and Bitcoin. On the other side, the oil price fell in price after an industry data showed another growth in the United States crude oil stockpiles, as globally supply uncertainty remained, and therefore the Brent crude oil price fell below 76 per barrel following 3 days. Before I come to Bitcoin and other markets today, here's very important what happened already in the last 2 days. Especially yesterday, we had the US housing starts for January, and the US housing starts refers to the number of new residential construction projects that have begun during a specific period. Typically measured this index or these numbers monthly, and it is a key economic indicator that provides insights into the health of the housing market and the broader economy. The numbers are published by the U.S. Census Bureau and the Department of Housing and Urban Development, the HUD, and this number reflects demand for housing, consumer confidence, economic activity. That means a rising trend suggests that economic growth, while a decline may indicate slowly activity. Estimated was 1.39 millions, and the current number released was below it 1.37 millions. Now you have attention what it does mean. The number was weaker than expected. Influences industries like construction, for example, or the real estate industry or manufacturing of building materials are, of course, very sensitive to this data. What to expect was that this release was unlikely to get a market reaction based on historical data. However, higher housing starts generally indicate economic strength, boosting the U.S. indices as investors anticipate growth in construction-related sectors, for example, while also supporting the U.S. dollar due to expectations of tighter monetary policy from the Federal Reserve. And of course, bond yields tend to rise as stronger economic activity raises inflation expectations. And if we look at the market, we see that the short, near, and mid-term, and also long-term bonds increased and started a higher high. On the other side, we have a divergence of the US dollar taking some profits. And of course, the NASDAQ, which has reached new all-time highs, started to fall again. Then we had yesterday also the FOMC meeting minutes on Wednesday, the 19th of February. This is not that very long fund rate meeting. It takes just some minutes. So the Federal Open Market Committee meeting or the FOMC meeting minutes are detailed records of the discussions held during the Federal Reserve's policy settings meetings and released 3 weeks after each FOMC meeting. These minutes provide insight into the committee's views on economic conditions, inflation, employment, and of course interest rates. That means that investors, traders, hedge funds, day traders, and others, and of course analysts, study the minute closely for clues about the Federal Reserve's future monetary policy decisions, as they reveal members' opinions and any potential shift in policy stance. What to expect was, so in my opinion, it was the same expectation. If the comments from the meeting minutes underline a more hawkish view from Fed official, that means underlining an unwillingness to cut rates or reduced confidence in inflation's sustainable return to target, then we would expect to see weakness in US stocks, strength in the US dollar and bond yields as day traders reduce their bets on rate cuts from the Fed, meaning they take possibly profits, they lose some positions, they don't add any more to their positions, so the volatility of the market will be influenced, and they prepare themselves possibly for a near to midterm coming bearish move. If the comments are more dovish, which means underlining a willingness to continue with interest rate reductions, what is not the case at the moment, or satisfaction with employment and inflation levels, and also this is not the case, we would expect to see strength in US stocks and weakness in the US dollar and bond yields as traders then would bolster bets on further Fed rate cuts, meaning adding to their long positions in stocks, crypto, buying more and expecting more bullish tension. Today, on Thursday the 20th, we expect the US weekly initial and continued jobless claims. And this means that the US weekly initial and continued jobless claims measure the number of people filing for unemployment benefits. It means that the initial jobless claims track new filings for unemployment insurance, for example, providing a real-time indicator of labor market conditions. So this indicator is very sensitive because it works in real time, week after week. It is the more updated data, we can say. We also have continued jobless claims that reflect the number of individuals still receiving unemployment benefits after their initial claim, offering insight into longer-term joblessness. Both data points are, of course, released weekly by the Department of Labor, and they are key indicators of economic health influencing market sentiment and Federal Reserve policy decisions. What to expect now today? The job market is part of the Federal Reserve's dual mandate, and the Fed are on the look for any meaningful weakening in the jobs market to potentially prompt a response with interest rates cuts. That means if the jobless claims numbers come out meaningfully higher than expected, indicating higher unemployment, this can lead, of course, to weakness in US stocks and, of course, strength in US dollar and government bond yields, as traders may take a weaker labor market as a sign that the Federal Reserve may intervene with rate cuts. If jobless claims come in lower, which indicates a lower unemployment, then this will reinforce the past data from the US, which shows a resilient labor market, but would likely cause traders to reduce bets, that means their positions on Fed rate cuts, so which could cause also weakness in US stocks and strengthens the US dollar and government bond yields, meaning the bonds and yields will go higher. We expect also today the US weekly EIA crude oil inventories, which are the US weekly EIA crude oil inventories report, and that are released by the Energy Information Administration. And this data measure the weekly change in the amount of crude oil which has held in US commercial storage facilities. It's a key indicator for energy market and reflects the balance between oil supply and demand. An increase in inventories suggests lower demand or higher production, meaning that the prices possibly can go down, often putting downward pressure on oil prices, while a decrease can indicate higher demand or reduced production, typically pushing prices up. So you just need to look at the expectation number. If the number below, meaning oil will go up. If the number is bigger than expected, then oil can go down. And tomorrow we have the US S&P Manufacturing and Services PMI, February prelim. That's very important. And University Michigan Sentiment Survey. So the US S&P PMIs measures the performance and activity level of the US services and manufacturing sector. It's based, for example, on a survey of purchasing managers. They ask the managers. And these numbers track variables like new orders, employment, businesses, activities, and input prices. As a diffusion index, a PMI reading above 50 indicates expansion, while a reading below 50 signals contraction. What does it mean? If the PMI's numbers comes in higher than expected, that indicates strong demand, which points to a resilient consumer and decreased fear of an economic slowdown. That means we don't come into recession. So again, if the number is higher than 50, it's good. That means for stocks and crypto, of course. This would be likely to cause strength across the US assets, for example, dollar, yields, stock markets, whereas if it comes in weaker than expected, we would expect weakness across the US stocks. Then we have the University of Michigan Sentiment Survey data, which will come out also tomorrow. When it comes to the headline sentiment read, for example, a higher consumer sentiment number at the moment would be seen as bullish for the US stocks and the dollar. It indicates that the consumer is feeling good about the economic environment, which reduces the chances for a hard landing coming out of this Fed tightening cycle. When it comes to inflation expectations, the market will want to see this coming in lower than expected, which would increase confidence in Federal Reserve's ability to reduce rates and start to stimulate the areas of economy that have shown weakness. How they do that? Well, they look just at the numbers. So the survey result is also a survey. The survey results, for example, are represented as an index with higher values, indicating greater consumer confidence. In this report, for example, respondents can give their forecasts for 1 year, and the other sector is 5 to 10 years from now on ahead inflation expectations, which the market sometimes pay attention to. So some long-term and mid-term traders, for example, use this indicator. Also, we have tomorrow again the US existing home sales in January, which measures the number of previously owned homes sold during the month. That's very important. Why? Because this includes single-family homes, townhouses, and also co-ops. And the report provides insight into the health of the housing market, consumer confidence, and of course, overall economic conditions. An increase in existing home sales indicates strong demand, and economic growth, while a decrease may signal a slowdown in the housing markets or a broader economy. So it is a key indicator of real estate trends in the US economy. What can we expect of this number? It's very simple. It is unlikely to cause a market reaction based on the prior month's data. As simple as it is. Having said that, higher than expected home sales would underline strong demand for homes from US consumers, which would help alleviate fears of an economic slowdown. And this would be likely to cause strength across US asset classes, for example, stocks, bonds, the dollar, commodities, and of course, crypto. And we see in the meantime, crypto is going down. Now we are talking about the levels. So yesterday, after a very volatile week, now finally the Bitcoin broke the very important 96,900. The high of yesterday is attempting to break the next high, 97,425. This is the high of 2 days ago. The next target will be at 98. If the market is breaking it, it will target the next level at 98,455, and then it will target 98,880. Again, we are at this moment at 97,470. The next target will be 97,995. If breaking that, the market can go a little bit higher to 98,435 and then targeting 99,315. You need to remember that these areas are the peaks of the chart, meaning very low value. So it can be expected that reaching those levels will, in a line with bearish data, create and initiate sudden and very quick and fast selling pressure, meaning as soon as the market reached that level, the sellers will start to push massively. If Bitcoin goes above that level, then the next target up will be 99,965. If breaking it, the next target is 100,335. If above it, 100,775. After reaching those levels, then we can say that Bitcoin can go to the next higher level at 102,800. And if reaching that, trying to reach 106,165 and then 107,380. It's very important. On the same time the market rises, it doesn't matter on which time frame you are. You can be on 1 minute, 5 minute, hourly, daily, whatever. You need also to keep focus on long-term time frames, and this is exactly that will make trouble, because on higher time frames the sentiment is bearish. It can be possible that we go again to 100 6 to 7,000 again, and then the market starts to sell down massively, unless the sentiment is bearish. And I see now, while talking this, now the long-term sentiment has been activated, meaning from here now we can expect that the market, or maybe the long-term and mid-term buyers, start to buy and push Bitcoin higher and higher. That's the good news. So I hope you will enjoy this. So we go then to the next market, and I start with NQ. And NQ started now a long-term bearish sell-off. We see now that the crypto is moving in divergence with NQ, while NASDAQ and S&P start to fall, and this is now a bearish trend has started. And also, if the market reaches again the old all-time highs, it will be a trap that Bitcoin and gold change directions and they go higher. So be careful with NASDAQ, very trappy these days. The higher it goes, the more traps you will have, and there are good possibilities to sell the all-time highs. In gold, we can say that the long-term, mid-term, and short-term momentum are excellently bullish. Also, gold will try to break now finally the 3,000 level and go reach higher. In oil, momentum still very high in all time frames, long-term, mid-term, and also in short-term times. So the next target will be 72.66, 72.90, and then going to 75. Once broken it will go to 80, unless the momentum, of course, doesn't fall. But the momentum in all those time frames is very bullish. We have a correction also in euro because of the coming elections on coming Sunday, on 23rd of February. We see here now an uptrend, but this is a correction in a very massive bearish trend. So the market can go much more higher, up to 1.047. This would be the first target. If it goes higher, the next target will be at about 1.0494, and the next target will be at 1.0521. But the momentum is very bearish at this moment, so you need also to check the higher time frame. I hope this analysis can help you somewhere with your trading. Subscribe to my channel, like it, share it. Have a good day.